Welcome to the Monitor podcast, where we dive deep into the latest trends, stories, and innovations shaping the equipment finance industry. Today, we're thrilled to have Jeffrey Elliott on the podcast to talk about Elevex Capital, a brand new company with a bold vision for transforming the equipment finance experience. Jeff has spent over 3 decades in the banking and finance industries, and now he's taking that wealth of experience to create a startup that's all about elevating and executing through innovation, technology, and a deep understanding of the markets the company serves. In this episode, we will talk about how Elevex is tackling underserved markets, leveraging cutting-edge technology, and bringing a fresh perspective to equipment finance. Jeff's passion for this new venture is contagious, and we are excited to share his insights with you. But before we dive in and hear from Jeff himself about this exciting new chapter for the industry, I want to tell you a little bit more about today's sponsor, Suite by Monitor. Suite by Monitor has the data, research, insights, and information to power better business decisions. There's no content resource for equipment finance leaders of all levels that can make this kind of weekly impact on your business and in your career. You can join Suite for only $150 a year or $15 a month. Don't let your competition have this advantage. Visit suitebymonitor.com to learn more. Hi, everyone. I'm Rita Garwood, Editor-in-Chief of Monitor. Joining me on the podcast today is Jeffrey Elliott. Jeff is founder and CEO of Elevex Capital, which is a brand new company, which is what we're going to be talking about today. I'm really excited to talk with you about this, Jeff. I know we had a conversation earlier, and I could just see how excited you are about this new venture. How about you just start off by telling us a little bit about it?
Sure. Yeah, it's an exciting time. Launched just this January, and Elevex is really a new type of leasing company, really focused on technology, advanced processes to provide fast and efficient and more transparent processes and expedite the process of closing lease transactions and funding for different capital markets activities. And it really comes around to us building a capital markets platform that enables us to buy transactions and sell transactions. We have our own balance sheet to fund transactions. And then lastly, one of the things we're focused on is being really good at asset management. So understanding the assets that we're financing. So what's the value today? What's the value 5 years from now? How can we set a residual on that? How do we remarket those assets? So really old school leasing from the old days, really understanding our assets and focus on the equipment more than just the credit itself. Obviously, credit analysis is important, but this is really a true leasing company where we're really playing in the assets and understanding the assets that we finance, and then taking it to customers that are underserved in the market. We see banks pulling back in the marketplace, and we think there's an opportunity to help customers out that aren't getting good financing from their current providers and play in some markets that are a little underserved, like the oil and gas market or the renewables market or the agricultural market, all areas that have had challenges for various reasons, but are still core to the U.S. economy and North American economy. And we think we can help a lot of those customers out. We're going to be North American based, so we'll be doing Canada, U.S., and Mexico, and all throughout, obviously, the United States. We'll do in various different types of equipment and industries. We'll have certain focuses on assets that we really enjoy. So certain areas will have more of a play in than others. But as we just build out the company, we'll just keep growing in different segments, and diversification is always key to my business models. So we'll have a diversified book of different industries and assets so that we can manage the risk of our portfolio. So that's kind of what we're trying to do. Elevex is really, the name comes from elevate and execute. It's also got a little bit of my name in it, but it's really just trying to elevate the equipment finance experience using technology and better understanding of our the equipment that we finance. And so that's what we're all about.
So exciting.
Mm-hmm.
So you talked about, the capital markets. You talked about serving customers that, are not currently being served by the market. What's your overall strategy for originations?
Yeah. So at the beginning, we're starting on the smaller end in transactions so that we keep our portfolio diversified. So a lot of vendor financing. Vendor financing has always been an important part of equipment finance and enables us to get a flow of smaller transactions in, kind of in that 100,000 to $2 million range, a little bigger than what most people think of small ticket, but we'll grow into the middle market and in the large ticket space as our portfolio grows and our equity base grows. We're going to have an approach with banks that don't have equipment finance, so providing those services for those like community banks that don't participate in the industry. That's an interesting market. There's a lot of customers there that are underserved because their banks don't do equipment finance. So we get a lot of business from that channel. And then we'll go into obviously buying deals in the capital markets. That's something we do up front and we'll always do. But after that, we'll start to do transportation verticals. So corporate aircraft, rail, marine, those assets. We're going to play. My investors are from the Texas area, so they've got good connections in the oil and gas space. And so that's an area that's super underserved by banks. They don't understand those markets. We're going to have some exposure there, not overly exposed in any one industry. So I don't want to build the whole portfolio in that because it's very cyclical, but we think there's a lot of good customers there, big companies that just don't have good equipment finance providers right now or understand those markets. So that's an area we'll focus on. And then, renewables is a space that I've been in for a long time. We'll play in the distributed generation areas of renewables. So not the really large deals like I used to do at the banks. These are more smaller transactions, say in the million to $25 million range, and where the credits aren't necessarily investment grade, but still large, strong credits that can finance those assets over a longer period of time. So that's a good market that's sorely needing funding. There's just not enough people with project finance knowledge to understand those markets. And then, like I said, agriculture is another area that is really underserved right now. The small banks used to do a lot of it, but they're under pressure by the regulators in that space. And so there are a lot of farm customers that are hurting right now and not getting their equipment finance needs met. So we think we can help them out as well. So little niches like that, we'll keep finding more of them and build business models around them and go after those markets and try to use technology to deliver a different experience than what people are seeing today.
You mentioned that technology a couple times. What is it about your technology that really sets you apart from, competitors out in the space?
Yeah, so we're taking some of the best things out of the banking world in terms of risk assessment and compliance activities so that we're fully compliant with what a bank would do, but speeding it up using the greatest technologies of today, right? So a good example would be if you know your customer, KYC and OFAC processes. At most banks, it's a manual process to do those things and check them out and get the documentation behind them. We're going to use what fintechs uses, more systematic approaches to find things in public databases. If it's not there, then we'll go the old school approach and get the normal documentation. But we can meet the letters of the law using technology much faster than way most people process transactions now. And quite honestly, you get a lot more extra information about the companies that you're proposing to by using those services. So there's a lot of information available, publicly available, that you can get on companies and individuals that will help you make a decision if they're the company to partner up with. So we use that as a not only a compliance and something you have to do, but something that we want to do because we learn about our customers and we can serve them better by knowing more about them. So know your customers are real important. That's something that technology can really help out with. And it's hard to do things fast if you don't use technology. So thinking about turning around lease transactions in mere minutes rather than days. That's the kind of things we're going to do. Use an AI to do things like compare lease documents. You take a base lease document and you got a specific lease document from on a deal, have AI compare the two and say, what's different? What's different from the base document? What's different from Elevex's document that we would normally put in a lease transaction? What's missing or what's different? And then that speeds up our document review process. Something that might cost $10,000 with an outside attorney, we can utilize AI to do it, at the cost of AI, but putting it in place each time is virtually free and super fast. So those types of things are what we're going to do to speed up the process, help our customers, get access to their equipment, understand what they got in their portfolio of assets, where it's located, all those things. Some, customers have multiple schedules of equipment all over the United States, and their internal systems don't necessarily provide them all the detail of where everything is. So we're going to provide that kind of information for our customers and help them make decisions on when to return assets, when to renew assets, when to buy assets out, those types of things, so that they really have transparency into their own equipment portfolios. And we want to help them with that because that'll help us in the end.
Yeah. There's so much you can do with technology today, and you get to start with kind of a blank slate, as opposed to, if you've been at a bank that has had this legacy technology and you're maybe building upon it.
Yeah.
Imagine the difference.
Yeah. Yeah, coming from that world, that is a huge advantage. I mean, it doesn't seem like it should be, but when you have legacy systems, to change those systems is expensive and super hard. And in a bank, everything technology is hard. It takes years. And so, being a startup, we can start blank and put in exactly what we want, the way we want it. Yeah, there's headaches to it. You got to do it still, and there's still cost and expense. We are really building the platform first and then sales later. So, we're not really even looking for a lot of new business right now. We have quite a pipeline of business just from people that I know have brought opportunities, but it's really about building out our systems capabilities first, so that when we go to market, we can really execute very well and meet our customer demands.
So how do you feel about making that switch? You were with banks for years, right?
Yeah, 30 plus years.
Now you're at a startup. What is it like making that switch?
It's exciting. It's refreshing. Banking was good to me, so I loved being a banker for a really long time. I will say banking has changed in the last 10 years. Ever since, well, really since the great financial crisis in 2008, 2009, we've just slowly gotten harder to do business with, more compliance, more oversight. The world is changing. When Silicon Valley Bank went down, things started to focus in more on deposits and diversification of deposits, and the overall deposit level is in decline. Right? People are putting their money in different places other than banks, both companies and individuals, and they can move money out of their accounts and off their cell phone in an instant. Right? So your stable deposit base that banks rely on for their funding is more challenging now than it used to be. So they are rightfully focused on deposit generation and bank customers that bring deposits, which is what they should be doing. And they are doing it. What that means for equipment finance companies, I think, is that they'll be less focused on doing just transactional equipment finance business. And you've seen pullbacks by some of the banks out there and in transactional type equipment finance business. I think that leaves an open market for independents to fill those gaps. I also think that banks will come in and out of the market, right? They make most of their money off of the loan portfolios. So when the loan portfolios amortize off, they go down, they dip back into the market and originate by buying deals, right? And that happened in the fourth quarter of last year. Banks amortized down and they got hungry again. Where in the spring, they didn't want a bunch of assets and then they got hungry. All the banks were out buying deals. So I think they'll just keep doing that. They'll amortize down and then they'll say, hey, we need to go buy some deals. And I view them more as a secondary capital markets participant in the future than a real direct competitor in a lot of transactions. Now, they're customers that have deposits and their line of credit with them. They're going to do equipment finance transactions with them forever. So that won't change. But some of the other side vertical businesses, like an aviation business or a rail business or a vendor financing, very much so, I think you'll see a pullback because it's viewed as primary bank customer, right? They're not usually customers with lines of credit with them or deposits. So I think they'll pull out of those businesses and open that market up for independents. And then they'll come in and fund independents by buying portfolios or providing warehouse lines and different types of credit facilities. And I kind of think of it back when I started in the business in the 90s, or even before I was in the business in the 80s. Banks were in the business, but they were more secondary markets in the business. And I think it's going to kind of go back to that, is my theory. Again, they're not going all the way out. They'll certainly have a direct presence and with a lot of customers, especially investment grade type customers. But I think on the smaller end, the smaller businesses, the medium businesses, the vendor financing, that type of stuff, I think you'll see that be more served by Elevex and competitors like mine in the independent space, because I don't think banks are as interested there. It's just not core to their mission anymore. And so it's just a change in the landscape.
Yeah. Yeah, we've been seeing that, the last year, 2 years or so. It's just such a trend, and it must have been kind of frustrating to be in that and not have the ability to grow like you used to be able to.
Yeah, I'm pretty entrepreneurial guy, people that know me. And so, I, at Huntington, I was, I started that company with 8 other people, and, we had zero and grew it up to, including all the different groups, we had like 27 billion, something like that. And it was fun building all those businesses, doing some acquisitions, buying portfolios, all those different things. And when you start to retrench and close down some of those businesses, or just shrink your volume expectations, it's not as much fun anymore for guys like me. So it's time to do something else. And taking on a challenge of independent is something I've always wanted to do. I used to do a lot of lending to leasing companies, so I kind of saw a lot of the fun that they had, the flexibility they had to do entrepreneurial type structuring and deals. And so I've always wanted to do something like this, and this was a great opportunity. And the other thing I wanted to do this for, I don't know if we talked about this before, was, I'm a big person, connected in the industry. I'm on the Alpha's board and was chairman of the foundation. And I owe this industry a lot. I built my whole career around it and friends with a lot of people. And I wanted to give something back. And what I think I can do here is train like the next generation of equipment finance people. So trying to put together a management team of the seasoned veterans that are interested in training people and working with people new to the industry, and then hiring a bunch of new people into the industry. They don't all have to be super young, but they just haven't been in the industry before, and seeing if they like the industry and training them up in credit and documentation and accounting and asset management and capital markets and sales, all those areas, and hopefully leave a legacy on the industry. It's important to me, and I feel like I'm the young guy, and I'm getting up there, and a lot of people are retiring on me. It's a sad every time I get another announcement. One of my friends is retiring, and so it's I think we need a next generation. So someone's got to help. That's the idea.
That's awesome. It's great that you're focusing on the next generation and really like investing your time and energy and building them up and making them, tomorrow's leaders. Happy to see people doing that always. You
Yeah.
talked about, building out your senior leadership team. Do you have that in place right now? Is there anything you want to talk about there? Anyone in particular?
Not yet. They're certain people are coming on board as we speak. They're I focused on operations first, so they weren't all there. We've got a head of operations that we're working on bringing on board here in probably February. So not there. There's no announcements yet, but yeah, they're coming. And it's a interesting time. People are looking at different things. Some are from banks world, some are coming from the independent world, and there's just a lot of change going on. And I think this appeals to a lot of people because they see the platform and what we're trying to build and the technology and the focus of what we're trying to do. They miss the old times of real leasing, and I think that's what we're trying to build. And so it's exciting.
It is exciting. I'm excited about it just hearing you talk about it. So,
Yeah.
is there anything that we haven't covered you think is important about the business you'd like, our listeners to know about?
Let's see. Yeah, I mean, I think the one of the things that people will, these mostly be viewed by people in our industry, which is great, is, get to know us, be a partner with us. We're going to try to partner with everybody. I know we're a competitor in some fashions, but we don't have to be, not talk to each other. We'll do deals together. There'll be deals that are too big for us to hold. We can split them and share them with people. We're going to buy deals and we're going to sell deals, so we can be a capital markets partner, or we're going to have access to funding sources that most people don't know, like community bank in North Dakota or something like that. Places all over the place. We're going to have different funding sources and capabilities. We're also going to have this big asset management capability that a lot of people don't have. And if they need a partner that can underwrite the asset and understand the asset and help structure a deal, we're going to try to be known for that. That's going to be one of our big points of emphasis. And so you get into something that you're not used to doing, a different asset type, something larger that you're doing that requires a larger residual position, you're not as comfortable there, we're going to be a good company to come to help you, vet that transaction out from an asset management perspective. We'll have our credit side. Our credit side is going to be very sophisticated between credit scoring and judgmental underwriting. We're going to line up with Moody's risk models. So very bank-like in that terms. So we'll show well in those underwritings when we're selling transactions, and then the equipment analysis is going to be, try to be the best it can be in the marketplace. So those are things I think people should know about us, and work with us together. And we'll have a bunch of people at the funding conference in April, and get out and meet everybody. But that's one of the core things that Elevex is going to bring to the marketplace.
That's great. One final question for you. Everyone right now is just talking about, the economic environment, everything that's happening with the Trump administration. Where do you see equipment finance heading in this year and maybe early next year?
Yeah, this is it's going to be a choppy year with different announcements coming out almost daily. I depending on what the new administration really does versus what they said they're going to do is going to make a difference, right? If we get large tariffs, that's going to be a challenge. We saw tariffs on China before, like in the renewables business, and that shut down renewables for the most part on solar panels. Like you couldn't get them, right? Because most of them were manufactured in China. It can in the future help equipment finance in the sense that it may speed up onshoring, right? Where we got more businesses starting up here in manufacturing in the United States, which I've always been a huge proponent of. I don't know why we ship things out of the country to be built that we could build right here. I mean, I know why we do it, but I don't think the math really works, because you see increases in shipping costs and risks of ships being seized and all kinds of things, and wages are going up in those other countries too. And so I think you just got to figure out how to build stuff here and not have so much risk across the oceans. But so there's good and bad that comes with some of those things. I do think with immigration, if it's done the way that it's being talked about, you have a significant loss of workers, and so where we're going to find those workers is challenging. I think that could take us into a recession, and so we didn't get the recession we thought we were going to get the last couple of years. Doesn't mean we won't get it now. I could feel that in some ways as a potential possibility here, and all that also means is potential inflation coming back, right? I mean, inflation is a trick thing. When prices go up, they don't usually go down very much, especially things like wages, right? And so once you get it, it kind of sticks around. Now, some products go back down, energy prices and sometimes in groceries, but a lot of things stick at those higher prices. So when you have things that are very inflationary, it does permanent damage to the economy, in my opinion. And so some of these things are potentially inflationary. That can help equipment finance, though. And when we went through those inflationary times, our equipment values were through the roof, right? So getting equipment off lease. Unfortunately, I don't have a bunch of equipment on lease yet, but I wish I did, because if we're facing another inflationary period, that's good for the asset managers. So, when you think about equipment finance, we live under almost any circumstance, right? When there's a bad economy, there's plays in equipment finance that work really well. So you get some more delinquencies and some more charge-offs, but you make some money on some other things. When things are going really good, people are buying lots of equipment because they're expanding, right? Well, that's another opportunity for us. So I think we'll do just fine, but you'll have to be nimble. I think independents can be a little bit more nimble than large financial institutions, but they'll do it too. They'll just curve back in certain markets and load up in other areas to backfill in. And so I think generally our industry is pretty protected against these big swings from an economic standpoint. And presidential administrations, they slowly make changes that affect the economy and businesses. But I think in general, we're going to have a pretty good year. But you got the normal recessionary caution to be concerned about. So I don't have a big portfolio to manage right now, so I'm not as worried. But as we add on assets, that'll become more of a worry.
Well, thanks for sharing your take on that. I feel like everybody has a different one every day. So
Yeah,
appreciate
there's a lot of opinions out there.
Thanks for taking the time, Jeff.
Yeah,
Congratulations on business, and we'll look forward to seeing what Elevex continues to do as you
yeah.
work in the industry.
Thanks, Rita. Talk to you soon.
Talk to you soon. Thanks.